By the summer of 1914, war was not the most dangerous option facing Europe's great powers. Default was. And the assassination in Sarajevo did not create instability, but arrived inside a system already stretched to its limit. And to see why that mattered, you have to look at what Europe actually ran on in 1914. Not just armies and alliances, but payments. Because money was moving across borders every day, and governments borrowed and banks lent. And trade ran on credit, and all of it depended on one assumption, that tomorrow's payments would still clear. And Britain sat at the center of that world, and London was where global finance met. Bills were settled, and shipping was financed there, and insurance was priced there. And if a government or bank needed short-term money, London was usually somewhere in the chain. And Germany was expanding fast. But its system depended on continued lending to keep industry and trade moving. And Austria-Hungary needed steady access to credit to manage its finances. And Russia relied heavily on foreign capital. And France had lent enormous sums abroad, especially to Russia, which made it not just an ally, but a creditor. And that mattered, because when one country borrowed, another country's banks or savers held the debt. And a Russian problem could become a French banking problem, and an Austrian shock could hit German credit. And anything that disrupted confidence in one place could spread quickly through the others. And trade didn't run on cash, it ran on promises, and someone expected to be paid later. And that meant trade didn't run on cargo, it ran on trust. And underneath all of it sat the gold standard. And currencies were tied to fixed gold values, and that made the system look stable, but it also made it rigid. And if money started leaving a country, governments couldn't simply create more, and they had to raise rates, tighten credit, and force the pressure onto their own economies. And so, by 1914, Europe had built something powerful and fragile. And countries competed politically, but financially, they were tied together every day, and they owed each other money, and their banks held each other's claims, and their trade depended on each other's credit. And as long as confidence held, that looked like stability. But the moment it didn't, everything connected to it would start to lock up at once. And by 1914, holding it together was becoming harder. And governments were spending heavily, because armies were expensive, and so was navies, and railways, industrial expansion, and great power competition all required money long before a war actually began. And much of that money was not sitting idle in treasuries, and it had to be raised, rolled over, refinanced, and defended. And that made the entire system dependent on timing. And short-term credit has to be renewed, and bonds have to be sold, and payments have to be met on schedule. And in 1914, that stability depended on confidence that governments would remain solvent, banks would remain liquid, and trade would keep moving. But confidence is strongest right before it starts to weaken, and once it weakens, it does not weaken politely. And a bank that feels exposed does not wait to be proven right. It protects itself and lends less, and it demands stronger collateral and keeps more cash on hand. And another bank sees that and does the same. And then credit becomes harder to obtain, not because money has vanished, but because trust has. And banks start holding back, and loans don't renew, while credit tightens. And under a looser monetary system, governments can try to absorb some of that pressure. But in 1914, under gold, they had much less room. And if confidence slipped and gold started to move out of the country, the response was not flexibility, it was defense. And rates went up, and credit tightened, and domestic borrowers got squeezed, and the discipline of gold was real. But so was the pain, and that pain did not stay neatly inside one balance sheet. And if investors became nervous about Austria-Hungary, that was not just an Austrian problem. It affected banks exposed to Austrian paper. And it affected borrowers who now faced tighter conditions. and other governments trying to raise funds in the same market. And the pressure moved through the connections, and the danger was that the structure had become dependent on smooth rollover, continued confidence, and uninterrupted credit across borders. And it was built to function efficiently in calm conditions, and it was not built to absorb fear. And by the summer of 1914, the machinery still worked, and ships moved, while bills cleared and governments borrowed. But the margin was gone, and the system was still running, until it had to prove it could keep running, and then couldn't. And once that question was forced, there was no gradual adjustment. Confidence doesn't fade evenly, it snaps. And credit tightens, and payments stall, and everything connected to it reacts at once. And that is why the assassination mattered, not because it created instability, but because it forced the system to prove it could hold, at the exact moment it no longer could. And default in 1914 did not mean one missed payment and a quiet negotiation. It meant a stop. And a government fails to meet its obligations, and investors pull back. And banks exposed to that debt take losses or face demands for cash they cannot meet immediately. And to protect themselves, they stop lending, and other banks do the same, and credit disappears, not because money is gone, but because no one is willing to extend it. And trade feels it next, and shipments that depended on short-term credit no longer move, and payments stall. And firms that rely on continuous financing cannot roll their positions. And what looked like a chain of normal transactions becomes a chain of interruptions. And governments are pulled into it because they still need to borrow and still need to pay soldiers, suppliers, and interest on existing debt. But the market they depend on starts to close, and rates rise, and access shrinks, and the ability to refinance, quietly, continuously, breaks down. And under the gold standard, the response is not flexibility, it is defense. And gold begins to leave the country. And to stop that, central banks raise rates and tighten credit, and that pulls money back in. But it also puts pressure on the domestic economy. Borrowing becomes more expensive, and businesses struggle to finance operations, and the strain spreads inward. And now, imagine that happening in more than one country at the same time. And the connections that made the system efficient in calm conditions make it unstable under stress. And a problem in one place is not contained, and it moves through banks, through investors, through trade routes, through expectations. And not as a single failure, but a cascade that forces everyone connected to it to react at once. And war rewrote the rules and allowed governments to stop the system from running on its normal terms. And they could suspend convertibility and could restrict the movement of gold. And they could close markets, limit withdrawals, and decide which payments continued and which did not. And they could direct credit instead of relying on it, and could allocate resources instead of waiting for markets to do it. And they could prioritize survival over obligation. And war made those actions possible because it replaced a system based on trust and continuous payment with one based on control and enforced priorities. And default removes control, and war restores it, at a cost. And in 1914, that trade mattered. And so, by the time the crisis hit in 1914, the choice was no longer between peace and war, and it was between two different kinds of failure, and one was uncontrolled and the other was controlled. And because in an uncontrolled collapse, losses move through the system unpredictably, and banks fail and businesses fail while savings disappear and the damage spreads outward and downward at the same time. And in a controlled environment, the losses are still there, but they move differently. And governments can delay payments and can direct credit, and they can hold parts of the system together while others absorb the shock. And they can decide which obligations are honored immediately and which are postponed. But it does not break all at once. And the war did not remove the financial pressure. It redirected it and stretched it out over time, and it moved it through inflation, state control, and changes in the system itself. And the cost did not disappear. It merely changed form, And most of that cost did not land on the institutions that helped build the system. And it landed on the people inside it, through prices and wages, through the slow erosion of purchasing power and the long adjustments that followed. And at that point, the goal changes, and it is no longer about keeping the system stable, and it is about controlling how it fails.